another episode, and today we are going to learn something different with respect to the final accounts of the sole trader. And as you already know, we've been dealing with some of the adjustments with or in accordance with the statements being prepared by the final accounts in a situation whereby there are some workings or additional information you're supposed to adjust or make some kind of workings under it. So today I want us to look at these two terminologies you've been hearing about them. One is bad debt, and the other is doubtful debt. Good. These are all debts, but they are different types of debt. We have the first one to be bad debt. When you say bad debt, what it simply means is that it's a debt which its recovery condition is very, very, very low. That is 0.0. You are not going to recover it. So it's a debt which is irrecoverable. A debt which is irrecoverable. The probability that you'll be able to recover this debt is 0.00. That's why we call bad debt. So the debt is bad. The debt is bad. Let's come to doubtful debt. Doubtful debt is similar to bad debt, just that in the case of doubtful debt, the condition that is available for you to be able to recover that debt is let me say 50-50. You'll be able to collect it, or you might not be able to collect it. But as an accountant and as a prudent concept also insists, you have to understand that not everyone who is owing you will be in the capacity to pay you. Even after a careful scrutiny of your account receivables or debtors amount, definitely some people will not be able to be in the position to defray their debt. So doubtful debt is a debt which is either or highly probable that you will recover or not be able to recover. So it's 50-50. And as a result of the prudent concept, we have to actually do this. When it comes to the case of the bad debt, we don't make provision for bad debt because the debt is bad. But in the case of the doubtful debt, we make provision. In the case of the bad debt, we make provision, we create provision for this because we might not know the final amount that we have to write it off as bad. So we make provision for doubtful debt. What are the conditions that will let an entity write a debt off as bad? Conditions for writing off a debt as bad. What are the conditions for writing off a debt as bad? In our journey in the accounting records keeping, we have to understand that bad debt and doubtful debt emanate as a result of people who are owing us, that is account receivable. So any of these two definitely are going to affect the account receivables. Nevertheless, there are certain conditions that will actually bring about bad debt or will let an entity write off a debt as bad. One can be the death of a customer. Another can be bankruptcy or insolvent or liquidation of an entity. If the company is bankrupt, the company is insolvent, if the company has liquidated, then it will become very, very, very difficult for you to get your bad. So definitely you have to write it off as bad. 3, insanity. Insanity of a customer. You sold something to a customer, right now the customer is no more. Customer is mad. On the roadside, the possibility that you'll be able to meet this customer and take your money is very, very low. You can also talk about whether the customer is minor. Customer is minor or infant. Infant, that is less than 18. Less than 18 years. So if the person less than 18 years, according to the laws of certain countries, you are not supposed to give sell on credit to the person. If your negligence takes you to the lid of that portion and you sell and the person is not able to be in the position to pay you, then in case the person is able to pay you, definitely you have to write it off at bad, because the person, if it goes to the law court, they can. So these are the conditions that will let an entity treat a debt as bad. So that is it. It's very, very important for you to understand that before we will know how much write off as bad, we must know the real value for account receivables. Account receivables are people that we sold to, or we render service. We render service to, or we render the service, but they wouldn't, or they were not in the position to pay us. So account receivables. So account receivables. And within the account receivables, we can get bad debt, and we can get provision for doubtful debt, PD, provision for doubtful debt. So before we can get bad debt, it will arise from account receivables. Provision for doubtful debt will also arise from account receivables. But among these two debts that I'm talking about, the most certain one is the bad debt. You are certain that the thing is bad. So before we can work on the provision for doubtful debt, the first thing we must take into recognition is the bad debt. How much is this bad, the debt that we are certain, how much is it? So we first of all, we want to know our final account receivables that will be represented in our statement of financial position or the balance sheet. So the question we have to be asking ourselves is that, do we have bad debt? Do we have bad debt? If you have bad debt, you must take recognition of the bad debt first. Take it from the account receivables before you have to also deal with the provision for doubtful debts. That is it. So let me continue. This is a typical Tribalance extract that we'll be using to illustrate the accounting treatment for bad debt and the provision for doubtful debt. It is obvious for you to know that the bad debt and provision for doubtful debt, as I said earlier on, emanate from account receivables. And therefore, without account receivables, it will be very difficult for you to create these expenses and liabilities. Bad debt is an expense item, that is why it is having debt balance, whilst provision is a liability. We all know what a liability is: a present obligation for you to transfer economic benefits or cash outflow. So account receivables is also an asset, that is why it is having a debit balance. This is an extract, so the trial balance, I'm not giving total. It will never be equal because I don't have all the items to balance the trial balance. But I just gave this question out of my head. Let's come to the additional information. This is a typical scenario how you can also get questions, or let me say you meet a very complex question with respect to the bad debt and provision for that for debt. In the additional information, you see further bad debt of 200 cedis should be written off. It is not always that you are going to get this clear statement like the one that has been stated in this additional information. It is not always. This is one of the cheapest additional information you can get in respect for bad debt. The examiner can say that one of the customers of so and so, that's the owner of the company, is in bankrupt, owing the company 200 cedis. Then you turn back to the conditions. So the examiner can use all the conditions to examine how bad debt can be created. In this scenario, we are lucky that the statement went straight further bad debt off. So you know that what we are talking about is bad debt. But what if I made it one of the customers of, let me say, Godfred Enterprise is dead. He was owing the company 200 cedis. One of the customers of Godfred is in receivership, meaning bad debt, you have to know. One of the customers of Godfred Enterprise has traveled. One of the customers of Godfred Enterprise, or one of the companies owing Godfred, is in bankrupt. When these things are happening, you have to put it at the back of your mind that we are talking about bad debt. But in this statement, you can see that it's so straight, it's so obvious that everybody knows that this statement is bad debt. Let me continue. You see, we have bad debt in the Tribalance, 500. And in the additional information, it is talking about further bad debt, which means that this debt that we have here, it has been recognized by the accountant in the Tribalance. It means the double entry was being made for this bad debt. That's why it has appeared in the Tribalance. But the one we have in the additional information wasn't captured by the accountant. That is why we have entrusted you with this additional information to readjust all the figures we have in there. And therefore, the final bad debt will never be 200 cedis, because we have further bad debt to be written off. Further bad debt. In order to get the total bad debt, so total bad debt, no, the way we adjust items, I will adjust this bad debt. The balance as per Tribalance. That's the balance per Tribalance, or balance BF, or opening balance 500 cedis. Ghana cedis. Since this 500 cedis is not the actual bad debt that the company or the organization has incurred, the additional information talking about further bad debt, this further bad debt wasn't taken care of in the Tribalance, and therefore it must be added. See, add further or additional bad debt, which is further bad debt is 200. So right now, our final bad debt expense is 700 cedis instead of the 500. So if you go to your income statement, expense for bad debt will no more be 500, but rather be 700. I hope you've gotten it. Thumbs up. Let's come to the provision for doubtful debt. The provision for doubtful debt should be increased by 50. It should be increased by 50. What are we trying to mean here? So let me adjust. Let me adjust this figure as well. Let me adjust this figure. We know that bad debt total is 700. That will go to our income statement. So the next item we are going to adjust is provision for, because we are talking about provision for doubtful debt. The same way, balance as per Tribalance, the provision is 250 at the credit. Always provision is at the credit, whether provision for depreciation or provision for doubtful debt is at the credit, because it's a liability. You are going to transfer economic benefit. That is why we always see provision. So even if a question is being given to you whereby it was just a list of balances, they couldn't group it debit credit, you must know that always provision is a liability. You can get something like that whereby the Tribalance wasn't grouped like debit credit, but they are just straight. You must know this an asset. So as I keep on saying, know the element of financial statements and their balances. What balance are they having? Asset. What balance are they having? Liability. What balance? According to the additional information too, the provision for doubtful debt should be increased by 50 cedis. Therefore, this 250 cedis we have here, they are saying it should be increased by. Listen to the word increased by. So it means that if I'm this, let me say I'm this, it should be increased by means that I should maintain the down there and increase it. Have you gotten it? Increase by. So what we are interested in right now is the buy. So it was like this, it goes up, so the difference is the 50. So they want the final. So here the final provision wasn't given to us, unlike those questions you've been seeing or you've been solving. So final provision, you see, I've made it black. We don't know. And always we compare. But the increase by the difference has been given to you. So increase in provision. Increase in, we don't know the final increase in provision. The increase has been given to us as 50. And we always compare the initial provision and the final provision. So if the initial is 250 and they are saying it has increased by 50, then we know that when we add the increase to the initial one to give us the 300, which will be what? The final provision. Let's compare and see. Initially it was 250. They are saying it should be increased by 50. So we add 50 to 250, making 300. So our final provision that will be deducted from the account receivables figure will be 300 cedis. I hope you've gotten it. If you go to your income statement, you don't send this 300 cedis. No, it is the increase. Because the increase in provision becomes an expense. The reason why increase in provision becomes an expense is that, listen to this. Provision itself is a liability. Increase in provision becomes an expense. Decrease in provision becomes an income. So if I have a loan amount of 10,000 Ghana cedis and the interest on it is 10%, which means the interest rate is 10%, but the interest itself, when we work 10% on 10,000, we will get 1,000 Ghana cedis. The 1,000 cedis, since right now the loan was 10,000, interest is 1,000, our liability has increased to 11,000. The additional 1,000 therefore becomes our expense. That's why we always say that interest on loan is an expense. So the same way for the provision. The provision itself was 250. Right now, it has management are saying, they are saying that it should be increased by 50, meaning that the final provision should be 300 seats. So this increase in provision becomes an expense. In the other way around, in case it was decrease in provision, then the decrease would have been other income, which will be added to our gross profit. Let's see the net effect on the account receivables with this additional information. So let me clean. Sorry, I've misplaced my duster, so I have to use my hands. So we already, I know in your book you've already written the bad debt, you've written the so account receivable. So I'm adjusting. So all this should be part of your workings. Account receivables. Say the balance as per Tribalance. The balance per Tribalance is 1,000. We have a further bad debt that the entity didn't treat. And since they didn't treat that further bad debt, you must treat it. So as I said, the first thing you must recognize, unless you don't have additional bad debt, if you don't have additional bad debt, you go straight to the provision, final provision for that for that. But because we have additional bad debt, that one must be taken from the receivables figure. So let's further, you see I'm writing further. You don't take the total bad debt because the 500 has already been worked on in the double entry session. It has been taken from the receivables figure already. So we are just dealing with the one that they've given to us in the additional information. So we say less further bad debt. The further bad debt was given to us as 200. If you take 200 from the 1,000, 800. So according to this entity, the real or certain account receivables, the one that we are certain, people who are owing us, we know and we assume that they will be able to defray their debt, is 800 cedis. But because of the prudent concept, anything can happen. The prudent concept is saying that although people are owing you, but still make provision in the case that if all of them are not able to defray this. So that is why we create provision. So we say that less final, you can just write final provision for that if you know what you are doing. I'm bringing this final provision to differentiate the reason why we are not just using any figure. So the final provision that we had was 300 cedis from our previous working. So 300. And therefore, if you take 300 from the 800, you will get 500. So if you go to your statement of financial position, the real account receivables that you have to record in the statement of financial position is 500 cedis. It's 500 cedis. So if you get bad debt, it's not difficult. This is how you go about it. In a situation whereby they are saying provision for doubtful debt should be increased to. So as at now, you must know these phrases. Increased by. decreased by. If it is increased by, decreased by, you don't know the final provision. So it's either, if it is increased by, you add the 50 to the original amount. If it is decreased by, you less the 50 from the original amount. So right now, if it was decreased by, we will less 50 from this, and they want the final provision to be 200. If it is increased to, it means the final provision has been given to you in the additional information, and therefore you are lucky. So your duty is going to be that you are going to find the increase or decrease. If it is decreased to, it means the final provision has been given to you, and your work is going to be what? Finding the decrease to. So you are going to find what? The difference, that's the increase or decrease. So it was decreased by how much? That's going to be your question. Decreased to means it was decreased by how much, and increased to means it was increased by how much. These are the 4 categories: increased by, decreased by, increased to, decreased to. You can get any of them, so be mindful of that. I think that's all. If you have any question, go through some of the questions we've solved. You are going to get it. So the highest at your level the examiner can go with respect to bad debts. If you don't have any further bad debts, my dear, you are lucky. That one, you don't deduct the 500 from the account receivables because it has been deducted. So if we weren't given the first additional information, we just take the 1,000 and we less the final provision 300. So the final account receivables will be 700 cedis. We deducted the further bad debt because it has not been taken care of by the entity. Thank you very much. We will have another session that we are also going to talk about another additional information. Bye bye.